This is going to be one of the most crucial policies of recent times. Amid uncertainties caused by the Russia-Ukraine conflict, commodity prices have gone through the roof, oil is on a boil, and perhaps for the first time since the pandemic, inflation has emerged as a bigger concern than growth for the Monetary Policy Committee. Now, in this backdrop, the MPC is expected to hold rates steady for the 11th consecutive time, despite the growing clamour that perhaps RBI may be behind the curve. 90% of the respondents to our poll expect no action on the reversed repo rate front, which would then have set the stage for an eventual repo rate hike. 7 in 10 expect the reversed repo liftoff to happen only by June. The MPC is also seen hiking repo rates only by August, as per one half of our respondents, the others expected by September, and so on. The street is divided on the quantum of rate hikes that we could see this year. A total repo rate hike of anywhere between 25 to 75 basis points is what's been built in. Now, while RBI may not change its stance just yet, the street is expecting a change in at least the wording of the stance and forward guidance, which could guide market participants for a potential change of stance to neutral. Now, on the macro front, retail inflation has breached RBI's upper limit of 6% for the second straight month. There are concerns about high wholesale prices feeding into consumer side, and the war in Ukraine has added unexpected price pressures. Against this, a majority expects the CPI inflation forecast to be hiked to 5 to 5.4%. The growth forecast for FY23 could also be lowered from 7.8% to 7.5% to 7.6%, or perhaps even lower. Among other regulatory measures, the street expects RBI to continue supporting an orderly evolution of the yield curve through bond purchases. There's also an expectation that RBI could extend the enhanced HTM dispensation by one more year, and we could hear some comments on bond indices inclusion.